Dun, 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 dun. I'm up all night to get lucky. What is going on, guys?
Welcome back. The Fed is
1 second, I
poised to
gotta
hold
do
rates steady
something
today,
real
and our
quick.
next guest says that move could be the first step in a policy mistake that could spoil the chances of a soft landing. But as of now, he sees a 50% chance of the market getting out relatively unscathed. Joining me now is Mohamed El-Erian, Allianz Chief
Cool.
Economic Advisor and former PIMCO CEO. Mohamed, great to see you. Welcome.
Thanks for having me, Kelly.
Do you think they should cut today?
I do. I'm in the camp that they should cut today because the economy is weakening much faster than they realize.
What do you point to for that?
So first, I listen very carefully to what the companies are saying, and whether it's Starbucks, McDonald's, PepsiCo, you can go down the list. They're all pointing to softening demand and a loss of pricing power. Secondly, I look at the cracks in the labor market, and I worry about that. And then I also look at what's happening to the lower segment of the consumer, and there's real pain there already. So when you put these three things together, there is a risk that they build on each other, and next thing you know, you
Sorry. All right, sorry. We're going to be getting a rate decision in about 11 minutes here, 10 and a half minutes. We'll be getting a rate decision. So you can see here, Mohamed El-Erian is suggesting that the Fed cut. It's probably because he wants his client stocks to rally. But I personally don't think the Fed is going to cut. There is no, according to the FOMC watch tool, there is no chance of a cut. Not no chance, but the market makers are betting that there is no Fed cut today. Obviously, there's a chance that anything happens. But if you take a look at this, you can see here that there is a 97.9% chance that the Fed keeps rates where they are. Now, I think it would be pretty stupid for the Fed to cut rates because we haven't yet achieved a 2% target on inflation. And according to their cooked numbers, inflation is coming down so fast that we are now at 3%. It would be very dumb to cut before we even get to the 2-something%, right? Ben Spurgeon, Z, what do you think about my mom? People come here to get their moms roasted. If you're here for the first time, don't ask me. I don't know how it came to this, but we are here now. So this is what we have to deal with. We have a breaker here on NQ. We put in a high so far at 11:30. There's a breaker here. I obviously am not going to be trading this yet until 2 o'clock when we get news, because you're going to see a whipsaw effect here where it's going to be taking out stops from both sides. But yeah. What do you think about Yield Max ETF? What do you think about Jamba Juice? I don't know, dude. What about Yield Max ETFs? Shout out to those of you that are attending the meetup tomorrow. Those RSVPs are now closed, but we are doing a meetup tomorrow in New York City. It's going to be a fun time for those of you who are attending. Those of us. Hopefully I'll be there too. What do you think about Stuff? Stuff Stuff is real good. What do you think about vague questions? I love them a lot. Nvidia, yesterday, a very strange move. No, it isn't strange. We have earnings, and AMD earnings were yesterday. So now, shout out to those of us who bought Microsoft at $390. I keep telling you guys this all the time. There is no better value than our trading floor. There just isn't. There just isn't. Yesterday, after market close, I said that I was adding Microsoft at $390. There was an overreaction to Microsoft missing cloud estimates by like $5 on a pack of chewing gum, okay? And the market went crazy over that for a very short time, and we got a gift of getting Microsoft at $390. Not only that, we double bagged this because I also traded an iron condor for Microsoft based on the fact that Microsoft rarely beats the expected move. So we traded a neutral strategy. So bagged 66% overnight on the iron condor and are up already 6 or 7% on our shares. Shout out to those of you who acted quick on that. But keep telling you guys, you don't join us, you're going to keep leaving money on the table, but it's up to you. All right. Rate cut decision in 6 minutes. What do you think about AMD tanking today after good earning? What? What do you think about AMD price right now for a short-term swing trade? See, at least that's a specific question. What do I think about AMD right now for a short-term swing trade? Sure, why not? I mean, it's not, to me, there is no swing trade pattern here. But if you wanted to buy AMD at somewhat of a discount, because it was trading at 220, currently trading on 142, sure, but this is not a swing trading pattern, so. What will be bullish for the market? If I have ice cream today, that is going to be the bottom sign. If I'm able to get a cone of ice cream today from Van Leeuwen, that marks the bottom. What will be bullish for the market in what sense, bro? Like, in terms of what? That's such a vague question. What's bullish for the market? Let's see. Liquidity, people buying stocks, low interest rates, euphoria. How about that inversion down there? Well, that is not an inversion because we didn't close above it. All right, let's see what the, wait, is this the Fed or what's breaking news here?
Most Fed watchers not expecting a change in rates today, but this could be.
Oh. The breaking news is that we have breaking news coming up. Here's what I'm looking at. Obviously, we are super bullish today, 2.6% up. Not a surprise. If you guys have been following my analysis in all seriousness is that we should not lose this level here. this is still normal pullback territory. I bought QQQ. I bought some NASDAQ because we got a 10% discount. I bought Microsoft. And then I sold cash secure puts on Broadcom, SOXL, and a few other things, Tesla. But right now we're in great shape for this to be a routine pullback. Let me just pull this Pro Mouse thing up. We obviously also completed one leg of the market maker sell model. You could see that consolidation, buy, sell, back to consolidation, right? However, there is a larger potential market maker model. You have consolidation, buy, and this might take us down here. Now, this would be even more of a gift in terms of price, but I don't like to see that kind of structure broken on a bull rally where we are likely expecting a rate cut at some point later in the year. I would like this bull rally to continue in a manner that is a little bit more predictable and not erratic, right? And we're also sitting at the 200 moving average, the 100 moving average, which is very normal. This is why, I was saying that this is a very normal pullback. A lot of you agreed with me on YouTube. Some of you were like, no, this is World War III. But so far, this is just a normal pullback, right? The S&P didn't even hit. If you look at the SPY, it did not even decline by a full 5%, I don't think, right? We had 4.7%, so not even a full 5% pullback on the SPY. And if you guys follow my analysis, you know that the S&P pulls back an average of 3 times a year of at least 5%. And so far, we only had one of those in April. So there is no need to panic here because recessions and bear markets are actually very rare. And I personally think that we won't get a recession until the 10-year and 2-year and the 10-year and 3-month both uninvert and the Fed cuts, right? I was talking about the inversion. Oh, on the 1 minute on NQ. Let's see. Yeah, I mean, this, if you would have to go. Okay, hold on. Let's hear the news.
The Federal Reserve left rates unchanged, but changed its statement in a way that may lay the groundwork for future rate cuts, though it doesn't necessarily guarantee it. I'll start off with the most important changes where the Fed said the risk to its employment and inflation goals, quote, continue to move into better balance rather than just have moved into better balance. And the committee says it's attentive to risks on both sides of the mandate, not just highly attentive to the inflation risk, which it had been saying for quite some time. They did continue to say that there won't be cuts, or they don't believe that there should be cuts until they have greater confidence of inflation moving towards a 2% goal. But they did talk about jobs and inflation. Let me go through that. They said job gains have moderated. That's a downgrade from remain strong in the prior statement. They noted the rise in the unemployment rate, but added that it remains low. They previously just said that the unemployment rate remains low. The statement notes an improved outlook on inflation, saying it has eased and remains somewhat elevated, adding the word somewhat. So they're less concerned, as you can see, with the inflation level. And said there's been some progress towards the 2% target, not just modest further progress. Guys, I'll leave it there with really it's a change in the balance of risks, I would say, from one where they clearly indicated they had their keen eye and highly attentive to inflation. Now they're watching both sides of the mandate. But I wouldn't say they guarantee a rate cut in the next meeting. They maybe just laid the groundwork for one if they feel it's necessary and the data cooperate between now and the September meeting. Tyler?
All right, Steve, thank you very much. Stick around as we get back to our panel for some reaction there. I think Steve has characterized it well. It feels to me like the language indicates that the Fed is putting the ball on the tee and is going to whack it real soon.
I think that's totally fair. And that's exactly, they have to talk.
Did this fool say They're about to whack it?
Telling us the risks have changed. Now it's about both sides of the mandate. They don't want to see the unemployment side of their mandate really start to suffer. And given that the unemployment rate has legitimately started to rise, arguably our opinion is it's more supply driven than demand driven, but it has started to rise. We're seeing the softening in the labor market, and the Fed has to be cognizant of that. They're trying to land the plane, and in order to do so, it makes sense to be cutting at this point, with inflation now coming back down very much below their 2.5% target on, or at least the 2.5 level that they've outlined on most measures when you look back on 1 and 12 months.
David, go ahead. What do you make of the market's reaction? It's largely treading water, or not treading water, but unchanged from going into the decision.
Well, I think it's probably more or less as expected. I do think there are quite a few comments, changes in the statement, all of which are in a dovish direction. So it's more than one or two gentle chimes indicating that a rate cut is coming. They're banging away in the gong quite a lot to let people know this rate cut is coming here. I am a little concerned. I don't want them to talk about this in terms of a weakening economy. I think they're on the right track if they say, look, we're going to normalize rates because inflation is normalizing. If they can stick on that theme, I think it'll be much less alarming than if they say, well, the unemployment rate's going up a bit and we're more worried about the other side of the mandate. Because as soon as the Federal Reserve expresses real worry about the state of the economy, that doesn't speed the economy up. That slows the economy down. So they need to be careful not to do that and just stick to the point that, look, inflation's coming down. That justifies us normalizing rates.
Jim, were there any surprises in what you hear in the language that Steve so ably summarized for us? And then I want to come back to your idea that a September rate cut is no better than a 50-50 chance. Do you still feel that way based on what the Fed has just said?
Yes, I do. So let me start there. Look, I mean, the two things I heard in the statement and what I'm queuing off of is moving it to better balance and focusing on both sides of the mandate. So what that really means is that we're not so worried about inflation anymore. We think it's moving in the right direction. Right now, the key is employment. It's jobs growth. We're going to get more data on Friday. We're going to get another payroll number before they move again. So look, we have this thing that we call a fear framework, which is the Fed, employment, asset prices, and interest rates. And essentially what the interplay is between all of these is the employment situation is the absolute key. If employment slows, doesn't collapse, but just cools enough such that wage inflation is coming down, that's the key ingredient that gives the Fed confidence to start to cut interest rates. We got an ECI data print today. Everything seems to be moving in the right direction, but still we have
Sorry, I was saying that we shorted the VIX using UVIXI, which is a leveraged ETF, right? I like when I short the VIX, I like to use a leveraged ETF versus the VIX itself. We're up almost 30% on this position. We built this position. Once I saw the VIX pop above 18, then we built this position on the fact that I thought we were nearing the bottom of this pullback. At least in the short term, and that earnings are actually going to not disappoint. We saw Microsoft beating earnings. Even Tesla had beat on EPS and revenue, but came in, had beat on revenue and not EPS. We saw AMD beat on revenue and EPS. Anyway, my point is that I wanted to ride the short-term volatility of the VIX and short it. So we built a position, and yes, I sent this out in the trading floor as well. We're up 30% on our position. I'm going to probably build a larger position in the VIX soon. But someone was asking, why is the VIX down? Let me ask you, why would the VIX be up? What would cause the VIX to be up? They just announced the rate cut decision. So, I mean, they just announced the rate decision, which is no change. So that uncertainty is out the window. And we already had some of the bigger companies reporting earnings, and it doesn't look like anything's on fire. So, you know, obviously we still have Amazon, Meta, and Apple earnings this week. Things could change, but already built a nice cushion there in the VIX. This guy is tough love. What did I say? Doc, what's going on, man? What did I say, guys? That I built a position in the VIX? We have Jerome Powell coming up in 20 minutes. As you guys know, the first move is usually the manipulative move, and then we get a real move. Another thing to note is that because just because a Fed rate decision and what Jerome Powell says is positive doesn't mean we'll get a green market today, and vice versa, right? We've seen many times the Fed rate remarks be negative and the market rallies, and vice versa. So today is just a day to induce a lot of trades, right? So they want to induce people to long the market or short the market so that they can take the real move later, right? So the first move that when Powell usually talks is the manipulation move. And those of you that have joined before in FOMC know that you know that we were always looking out for the manipulation to take the counter trade. Now, it doesn't mean that I'm going to trade necessarily right after Powell starts or stops talking. The setup still has to be there. But I am what I am skeptical about every time these things happen is the manipulation move. You gonna give a discount code for the Discord? No. You won't get another discount until maybe Black Friday. What we offer is too valuable to just be giving discounts left and right. And you know, between the long-term stock alerts, the options plays, the earnings plays, the day trading, the live streams, it's, in my opinion, a steal. You know, and when we have people in there making thousands of dollars a day, I'm not going to discount it further than that. I already think it's discounted. So. All right. Just waiting on Powell's comments here. These plays have already paid for a lifetime membership for me. Hell yeah. Average dad saves money. Is the Discord good for beginners? I'll tell you this. And I'll let other people who are in the Discord tell you, but it's definitely, when you say is it good for beginners, it's definitely, if someone wants to learn, it's definitely the best place to be, in my opinion. But you're not going to get a bunch of easy plays, meaning, you know, buy these calls, buy these puts, buy these calls, buy these puts, where I'm giving you something that's less than a 50% win rate just so that you can enter easy plays and maybe make money out of one out of every 5 plays. It's not that type. If you really want to learn how to trade, then it is the best place to be for a beginner. If you have no interest in really learning how to trade and you just want as many signals as possible, it's definitely not for you. Do you use ICT? I use some ICT concepts, yes. Jerome gonna be dovish and dump on us all? Dovish means not hawkish, so I think you have your terms opposite. Lewis, what's going on, bro? Does your Discord go through ICT in a well-guided form? Yeah, I mean, if you're part of the mastermind. But yes, I mean, we are trading ICT concepts in our futures day trades. I'm long TLT. Yes, me too. I'm starting to build a position in TLT. I did start to build a position in TLT starting in, what was it, October, November of last year. And I will continue to build a position in TLT. Let's see what the Fed says here.
That really is the issue here. Take a step back. Look at the size of these refundings. 125 billion for 3s, 10s, and 30s. That is so much larger than it was just several years ago. And why were they allowed to create such huge deficits? Because the Fed kept rates too low too long. They can't make the mistake again of being an enabler. We still have an administration that loves to overspend. They need to keep these rates higher for longer. One rate cut won't be a big deal, but they're going to trap themselves. The market says SEP. They're right in tune with the market. I hear people say 50-50. It certainly doesn't look 50-50 to me. But what is going to be a problem is how they set the stage after the first rate cut, because give an inch, give a up to the elbow. They're going to want the whole thing. They're going to want more rate cuts. And the Fed really needs to be cognizant of the fact that we are now potentially looking at a Minsky moment when it comes to supply, and they're at the epicenter of how we frame the equation for how much we can spend, how much we can borrow.
I mean, I happen to agree with Rick Santelli there. The government spends way too much money, but I do want to hear what Jerome Powell has to say. So what we're looking for here is Jerome Powell going to juice the markets by giving us a hint that he is going to cut in September? And the reason is because that is what's priced in, right? Now, the market doesn't like surprises. So if you take a look at September here, you see that 100% chance, 100% prediction that the Fed is going to cut rates. One cut of 25 basis points is a 93.5% chance. 6.5% chance that the Fed does 50 basis points, right? But if you, and then 0.1% chance that it does 75 basis points. But if you add all these up, this is 100%. So there is no, the market is not baking in any probability that the Fed doesn't cut in September. So if Jerome Powell comes out and basically confirms what the market is expecting, then that will be quote unquote good. And I think that the chance, as long as earnings don't disappoint too much, the chance of this being the bottom of this pullback is very, very high. If somehow his handlers are telling him, no, you need to put more pressure on the markets and the economy, you have to talk your shit, then he'll come out and say, I have no idea about September. As a matter of fact, I don't know why you guys are pricing in a cut in September. That's not what I'm looking at, right? So if he comes out and says that, I think the market continues tanking over the coming days and weeks, down to at least that consolidation level that I talked about a few minutes ago. So that's what I'm looking for. My biggest issue is education. You have to learn on your own so you can follow in the Discord. No, you don't have to learn on your own, but if you're wanting a very structured class, then yeah, either you learn on your own or you join the mastermind, which is a class that I teach personally over the course of 4 weeks. It's 2 classes a week. It's not recorded. It's interactive. So yeah, of course, you either have to learn on your own or join a class, or else how else are you going to know how trades are structured? That's only common sense. No one can type to you how to trade in real time, right? If everyone's trying to trade, like you can get help on questions if you're like, hey, what's a fair value gap? Or, you know, why are you looking at that order block? Or why are you looking at that breaker? Or why is your stop limit there? Yeah, you can, people ask questions like this all day, but you're not going to learn a full spectrum of how to trade without either doing it on your own or joining a class. That's just common sense, bro. Morning meetings till noon kills my trading. Then master the London session. There's the London silver bullet between 3 and 4 a.m. Master that. Keep only Nvidia. Other stocks are trush. Motherfucker can't even spell trash right. What do you think of the new M5? Doc, BMW has a very unique way of finding the money in my bank account. That's what I think of it. I want to drive it so bad. It's like 700 something horsepower. That thing looks insane. But I was looking at the M4, the 2025 M4, because they did a refresh. So I was looking at that as potentially the next car. And then I saw the M5 and I'm like, oh my God. I'm a big fan of 740i. I'm not. The 740, the 7 Series in general is a car that you have to be driven in. It's not a car that you drive yourself in. So if you have a driver, then yeah, I like the 7 Series. Otherwise, I'm not getting in that fucking boat and driving it myself. I ordered the X6 M Comp. Wait, you know I have that car, right, Lewis? I had the 2022. Yeah, for real. Yeah, it's black with the red interior. You bought your car or lease? That car I leased because it also qualifies for the Section 179 exception. So you can write it off. You can write off the depreciation as part of your business. Yeah. People are so dumb when it comes to leasing versus buying, right? Because they think, oh, you leased a car, that means that you can't afford it, or leasing means long-term rent. No, that's not what it means. And there can be great lease deals that are tax advantaged, and there can be bad lease deals, and there can be great financing deals, and trust me, there could be horrible financing deals. And there can be great cash deals and horrible cash deals. Like if you try to buy a new Corvette, you're gonna get shafted on the sticker price so bad, it's insane. So leases aren't bad, financing isn't bad, cash isn't bad. There are good and bad versions of this stuff, depending on your situation and your tax benefits. But I really, really, really hate when people are like, oh, I only buy my cars cash. Well, you're a fool because there can be situations where not buying a car cash is actually very helpful. We're just waiting on Powell here. 9 minutes, guys. 9 minutes waiting on Powell. Man, I should have entered this long on crude oil after they released the inventories at 10 a.m. That was the key liquidity sweep right there. NVIDIA, your comments, please. My comments. My comments are, I remember when NVIDIA was a very small graphics card company. And I used to be able to afford those cards really easily. And then when I got to college and was in debt, NVIDIA's graphics cards became more and more and more expensive. And all of a sudden, it was like $1,000 for a really good graphics card. That's my comment. Do you know any other cards off the top of your head that you can depreciate? Ask your accountant. Don't take it from some guy on YouTube. But ask your accountant about section 179. And you'll see here that there are a list of vehicles that qualify for section 179. Right? The X5, X6, X7, the Bentley Bentayga. There's a ton of cars here. By the way, the Lamborghini Urus as well. But it's not on this list. But just look up section 179 and talk to your accountant. Don't take my word for it. I'm not an accountant. The only reason I knew about this is because of my accountant. Do your course apply for EU people? Yes, we have a ton of Europeans in the Discord. G-Man, stop being annoying, bro. I'm on stream. I can't hop into the Discord to answer your question. Just tag Justin or Kirsten. I'm thinking about
Welcome back to Power Lunch. We're just moments away from Fed Chair Powell's press conference. We often see the bigger moves based on what investors hear or don't hear from him versus just the decision itself, which we already have. Let's bring in Claudia Sahm, New Century Advisors chief economist, creator. Oh, we have the same kind of wardrobe vibes, too. Creator of the Sahm Rule, the recession indicator. She was among the 3 members of our mock Fed panel who voted for a cut this month. I was just reading your latest missive, Ms. Sahm, and it's quite clear. You say cut. So what do you want to hear from the chair?
An explanation of why they didn't cut. Right, like the case is there. The case is there on the inflation data, both the data in hand, some of the forward-looking inflation data. Right, we're at 2.5% PC inflation year over year, and to be calling this some further progress. Right, so, like what is it they're looking for? I think the bar is getting set pretty high, and that really doesn't make a lot of sense. The Fed needs to start that process back gradually to normal, which means gradually reducing interest rates.
There are, as we've been debating this the past hour or so, there are viewers and Americans who are concerned and think this is all about appeasing Wall Street, and they're liquidity junkies, and they just want lower rates, and it's self-interested, and it's not in the interest of the average person. What would you say to that?
The Fed's mandate, the one they're given by law from Congress, is low inflation and low unemployment. And that is their focus. And that's, the tools they have. Interest rates aren't
So all these clown show people want the Fed to cut, which is ridiculous because we have so much liquidity. I don't understand. What are they trying? Oh. I don't understand why they want the Fed to cut so bad. Besides, obviously, they want their stocks to rocket because they probably bought late. But there's just no reason for the Fed to cut. I cannot believe that these people who are educated in the best economic schools are like, I'm so surprised they didn't cut, and I need an explanation of why they didn't cut. Like, yo, if this dude who makes YouTube videos knows what the Fed is going to, how are you surprised? In all fairness, I did go to finance school, but I mean, these people are in, you know, high positions of economics. I'm just like, it's just crazy to me. I don't know. I'm like, are they really serious or are they acting? There has to be an act. They can't be this dumb. Are you a CFA? No, I'm not a CFA. They must be way more knowledgeable than Traveling Trader. She has way more books in the background. Bro, I'm not even at home. 10-year dropping. Yeah, Powell hasn't started talking yet. What would be a good indication for the Fed to drop rates? One of two things. Either the system starts crashing or inflation gets to 2%.
Claudia, thank you. Jerome Powell now, the chairman of the Fed.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like that. Again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market, and, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's time. It's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game, and that's why we look at 12 months. 12 months, because that takes all that out, all those things out.
All right, guys. So he isn't really saying much. He's not being hawkish, in my opinion. He is a little bit dovish, saying that the economy is doing fine, that the economy isn't really crashing the way some economists have expected, but that, we need to see more data, blah, 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 before cutting rates. So, yeah, he isn't really committing to September cut, and he is sort of diminishing the fact that unemployment is going up. So, he's saying that inflation is trending in the right way and that they're confident based on the numbers that we've currently seen. So honestly, this is all stuff that I expected him to say. Obviously, I didn't expect him to say that, we're going to get a cut for sure in September, or we're not going to get a cut in September. But yeah, I took a trade on NQ just for that manipulation down. And I'm waiting to see. I mean, it's insane to, you know, short a 3% day. Here's the thing. I think there will be a short trade, but it doesn't mean that, you know, having a short trade doesn't mean that we lose all of today's gains. Like, imagine if you just had a short trade that goes, you know, from here back to this swing low, for instance, right? That doesn't mean that the day is bearish. But, you know, aside from trying to long these retracements, the only trade that you would have here is a counter trade once he's done talking, right? So he started talking at 2:30 right here. Then we had a pop up, and then a pop down, and then another rally. So, you know, when he's done talking, you can expect a shorter counter trade, but I would not bet on some sort of crazy reversal here just yet. AMD getting disrespected. Yeah, super disrespected, bro. AMD's up 5% today. Hella disrespected. Where you guys get this stuff, man? Nvidia's up 14%. Yeah, who said the AI bubble was dead? We picked up some Nvidia as well in the trading floor. Do I trade TNA? I don't know where you're from, Marianne Stoyanov. TNA has a very specific meaning in the United States, and it has nothing to do with trading, ma'am. So, not sure what you're referring to. Hey, bro. I'm from India. All right. We don't hand out cookies to members just because they're from India, so I'm not sure what it is you expected from that. But we have members from all around the world. One of the countries is India. Welcome. A cookie for the Indian. What was your entry on UVIX? You know what? There's no point. There's no point in chasing this, dude. Like I said, you guys want all of the up-to-date trades. Where am I going to give you the up-to-date trades? I make a video a couple times a week and tell you what I'm going to do. If you want the most up-to-date trades, they are in the Discord to the minute. What day did I send the UVIXY trade? July 24th. This was 6 days ago. I sent that UVIXY trade out. So you're going to try to capture what I captured in 6 days by chasing it today. You know, you either join the Discord or you don't, bro. Like, there isn't any way for me to convey my trades in real time to you besides that. Remember when I told you IWM is going to all-time highs? I'm going to go back and look for how many people laughed at that. But we got an IWM in November. Are you on Instagram? Yes. We got an IWM in November. And I said back then that we are going to all-time highs. The SPY, yeah, we bought the SPY at 410. So we're 7% away from all-time highs on IWM. Are you invested in Chipotle? Yes, I bought some Chipotle. When did I buy Chipotle? If you guys think that like this stuff is all made up, well, one, there's a lot of people here that are in the Discord. And two, I can show you. Last week, I bought Chipotle. So I don't buy stocks every day, but I promise you what I buy is all asymmetrical. I wait for the right moments and then I strike. So yeah, I bought Chipotle, I bought Nvidia, I bought Microsoft at 390, I bought Google 130, I bought the SPY at 410, I bought IWM. What was the price that I bought IWM at? Like 180, I think. 170-ish. But I'm not out here just buying shit left and right. I bought Tesla at 150. I have cash secure puts on CrowdStrike. Yes. Roberto Martinez, thank you so much for donating $20 Canadian. I wish I had IWM in November too. Well, you would have. You guys know where to find me. Here's my IWM from November 10th. And then back after I bought in November, I then gave another update in December when I said IWM could be posed for another run towards all-time highs. That was back in December. So people can like, you know, try to act like they saw everything coming on YouTube. But we're actually putting date stamps to this shit. No, not bullish on bonds in the next few months. I'm bullish on bonds for the next few years. To join, do we use WAP? Yeah, look at that first thing in the description there. Right here, where it says memberships to our trading floor are now open. It's that WAP link. That's how you join. This one right here. How do you feel about TLT at 90? I feel all warm and fuzzy. Why, when selling calls and the stock goes up past a strike, the position goes negative? Oof. Bro, you need to stay away from options if you haven't figured out the answer to that. It's common sense. You're giving someone else the right to buy a stock at a certain price. So if you sold calls to someone else, so say you sold calls to someone else for Tesla at 220, and Tesla is now 250, that means they have the right to buy it from you at 220, which means you have to go out into the market at 250 and sell it to them at 220, hence losing $30 per share. You should not sell calls unless you have shares. Hell yeah, good job, Prod. Good job on that eval. WAP is giving me an error when I try to join? Really? Who else? No, there's no error. I see it right here. How do you go about finding a CPA? Fucking Google. There are CPAs in your hometown. I don't know. It's like, how do you go about finding a dentist? You're not going to get scammed. It's not like there's a bunch of people walking around acting like dentists that aren't really dentists. How do I find the closest Chipotle next to me? Dude, it's not insulting. It's like, how do you find anyone in your local area? If you say you live in St. Louis, how do I find a CPA? How do I find a dentist? How do I find a cake maker? Honestly, like, just Google. That dude is annoying. All right, I want to see if we can find a counter trade here. Maybe he doesn't have internet. How is he chatting with me then? How do I find a girlfriend? Yeah, no worries, William. No worries, bro. I'm glad it helped. All right, I want to see what happens off this mitigation block here. We might get a small trade down.
In politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean. Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, and I would be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. You know, the data overall show a strong labor market. You know, so that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. You know, we're watching to see, you know, which way the economy heads, and I think if we are to respond to weakness, we're certainly, you know, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, you know, a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
Yeah, I mean, I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, you know, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, you know, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on that, on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
And welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. Fed Chair Powell wrapping up his news conference there. Stocks already up sharply before the decision, adding to those gains. The market clearly believing the Fed is teeing up rate cuts in the months ahead. You can take a look here. NASDAQ is, for one, the place to start looking because it's up better than 3%. That is the best day for the NASDAQ since February of 2023. But stocks are up sharply across the board. The money lines here from the Fed chair pretty clear, too. When asked directly about a cut coming in September, Chair Powell said, quote, "There's a broad sense that the economy is moving closer to the point where it would be appropriate to reduce the policy rate. On cuts in September could be on the table as soon as the next meeting," he said, that they've gained a greater confidence that inflation is moving closer to target. They do want to see more, doesn't want to see much more weakening in the labor market, simply thinks that it is normalizing right now and not getting any worse than that. So with that, let's welcome in exclusively Jeffrey Gundlach. He's the CEO and CIO and founder of Double Line Capital. Jeffrey, welcome back. It's good to have you as always.
Yeah, good to be back on Fed.
What is going on, guys? All right, I'm going to move this. I'm going to move this. Like I said, I think we'll get a counter trade here. You know, I don't know that it's a 3% day, so I don't know that we lose the entire days of gains, but I think we get a down move to one of these swing lows here. I hope it gives us a retracement. That would be whack if not. Please take a look at today's gap for NVIDIA. What about it? I already bought NVIDIA. I don't need to do anything today. But what about the gap specifically interests you? You got to strike while the iron's hot, guys. NVIDIA's up 14% today, and everyone is like, oh my God, I should have bought. Yeah, you should have bought. This happens every single time. Every single time. I promise if the stocks tank one more time, I'll buy it. I promise. Stocks tank. Nobody buys. Is it time to buy now? This happens all the time. There's nothing new. Everyone promises that they're going to buy, and nobody does. Have you heard about Dynatrace? No. What is that? Thoughts on why AMD has been dropping? It's up 4%, guys. Up 4%. What do you want it to do? Come on. Yeah, give me some trade, bruh. I was looking for a short, not a long. Remember, as I said, when the move that happens during Jerome Powell's speech, when he's done talking, the opposite move happens. All right, I'm looking to see. What's your thoughts about Bob Kendall? Who the hell's that? What the F happened? Oh, man. All right, I want to see if. Iran attack. You guys really think this is about geopolitics? You're funny. This has nothing to do with geopolitics, guys. We had FOMC. Like Jerome Powell just got done talking. But it doesn't help? Okay. Then why hasn't the market crashed like it's 1987? Why is the NASDAQ up 2.6% and S&P's up 1.5%? If you really think this has anything to do with geopolitics, you need to revisit your knowledge on the market. All right. Man, there's half an hour until market. Yesterday before closing? Yeah, but I mean, the VIX is still down 11%, which is wild. Nineteen two eight eight 75. Exactly. Swift snail hit it right on the head. It happens every time during FOMC. Like I said, you have the initial move, which is the manipulation, and then you have the move after Powell's done talking. And sometimes you have then another move back up. So I'm trying to see if we can find a potential move back up. I might take a crack at a long here. To get to just that high right there. $19,526.25. For some reason, I can't bring my screen around. For some reason, I can't bring my my screen around, but I can take a screenshot. This is my long here. I want to get to that high right there. Up 600 on this. Up 800, guys. I'm booking that. $825 on that move. $825 on that move, guys. For some reason I can't bring my Thinkorswim window, so I have to keep taking screenshots of it because I have 3 screens here. Now the reason that I booked it right there is because that was my that was the initial inverted fair value gap on the 5-minute. That was the initial fair value gap. 5-minute inverted fair value gap. So I took it when we closed above here and we retested that 1-minute inverted gap, and I was targeting a short-term high. So the short-term high that I was targeting initially was this high, but because I did my future self a favor and marked up the chart, this blue rectangle here is the 5-minute inverted gap. So I took profit there. Quick and dirty, 800 bucks. Quick and dirty, 800 bucks, guys. Would have already paid for you guys for the year off that one trade. And I live stream with the crew every single day. I'm not on YouTube every day, but I'm on the Discord live streaming every single day, so you can watch me trade on there. But easy money. Hacking World says market officially turned boring, except for Hacking World doesn't have the skills to make 800 bucks in a few seconds. So it's all about finding an entry. As I told you guys, you're going to have the initial move when Powell talks. Then you're going to have the counter move when Powell's done talking. And if it sets up and we take liquidity below an interim term low and we get an inverted 1-minute gap, we could take that to an interim point of interest, which initially was this high until I remembered this was the 5-minute inverted gap. So hopefully, are you trading on PA accounts? No, that's my real money. It's not even a PA, it's a real money account. As in Thinkorswim my own funds, not even a prop firm. But a lot of people do trade prop firm. I do trade prop for fun, and you know, like I said, I wanted to get a sense for the prop firm game because a lot of my students and a lot of people online trade props, so I wanted to be familiar with it and not just poo-poo it. So I do have prop accounts, but I mainly trade in my real money account. Not enough spamming W's in here for me to believe you're legit. One, I don't give a fuck what you believe. I live stream on here as a favor to you guys. Two, whether people choose to post W's or not, I don't really care. The smart people made money. The people that worry about emojis and W's, like you, probably didn't. So YouTube crowd is weird. I know, Lewis. I know, bro. This is why every time I say, man, I'm gonna fucking take over YouTube live streaming, I'm like, do I really want to spend my day doing that? You know, I'll live stream like the important events because it's important and I like to give away free info, but can my brain take live streaming every day? I don't know. I don't know. So shout out to all those that live stream every day. I don't know how you keep your sanity, but gratitude is missing in YouTube. Oh, that's a big revelation, bro. I have to agree with you. It did eventually hit that interim term high. Gave us a heart attack off the 5-minute IFVG. It eventually hit that high, but was it worth it for me to be a dick for a tick for another 14 points? Or sorry, 12 points? No. If you think YouTube is bad, you should try Twitch. Funny enough, this is live streaming on Twitch. That's the funny part. I don't even know how to access Twitch. That's the funny part, is that this right now, what you're seeing is live streaming on X and on Twitch as well. Not only YouTube. That's the funny part. Even the free Discord is worth it. Appreciate you, Maisha. Yeah, I try to give you guys, you know, try to lead people on the right track in terms of how to think about investments and risk management, things of that nature. So even just follow me on Twitter or on X and on Instagram, because I post a lot of nuggets in there as well. Yeah, waited like a hunter for that fucking trade. Had to hear all these weirdos asking Jerome Powell questions about nothing. But when we got the entry, we got the entry. So happy those of you that took the trade. Not too shabby, honestly. It's crazy, man. To be honest, like all in all today with the VIX puts, with the futures trades, with the Iron Condor on Microsoft, with the Tesla plays, with my cash secure puts, like, thank God, but I'm up 7,300 on the day. Ish. 73, 79, exactly. You don't need to go for home runs, guys. Just optimal moves. That is not a good trade. It's too risky. Look, it went up more. Motherfucker contradicted himself in one sentence. He said, that's not a good trade. It's too risky. And then he says, look, it went up more. Dumb fuck. If you have an entry model and the trade fits your entry model, then it's a good trade. Is this turtle soup? No, it's not turtle soup. A turtle soup would be if you had, say, a high time frame PD array, like if you were targeting, say for instance, if you were targeting this low here from June, and the minute that it hit that, you bought it, right? You really have to be very precise about your turtle soups. But the minute that it hit that yellow line, for instance, you bought it. That's a turtle soup. I admittedly am not a turtle soup trader. There are times I will take it, but it's not something that I have spent a lot of time back testing. So it's not something that I'll spend a lot of time trading because I haven't yet perfected that entry model. What this is essentially, one, me knowing how FOMC behaves, the manipulation move, and then the real move, and then sometimes you'll get a move back up if you void an important area of liquidity. So we completed that market maker sell model that I was talking about earlier, right? Here's the buy model, the reversal, then the sell model. But where we landed was twofold. One, below this low, we swept liquidity below this low. And I appreciate you, those of you who are staying behind to listen to this, because I know it can get cumbersome, right? So there's the swing low. And then this was also, what was this area? Oh, this was a breaker from all the way back here. But the main draw wasn't really the breaker. The main draw was this swing low, right? But what alerted me to enter was the sharp turn above this 1 minute gap. So if you look at this, this essentially is a bearish fair value gap, right? So you're making lower highs and lower lows, okay? But then you dip into a major liquidity pool, which is below this low. So you dip into a major liquidity pool. How do you know when to enter? Either you wait for a 2022 model, which is a break of structure, and then a retrace, which on days like today, you will probably not get because it's so violent. Or there's a more aggressive model, which is entering the minute that we close above what was the bearish fair value gap. Now this turns into what we call an inverted fair value gap, IFVG, right? So you enter here. Now sometimes you get a retracement back into this IFVG and you can enter more contracts in here. So if you took one contract here, you can enter another one here, right? This case is FOMC. I like to keep my risk light. And I already made a good amount of money today, so I don't need to over lever myself, but I did want to be in this. But that right there is the trigger. So shout out to whoever said this was risky. It's just because you're not familiar with the entry model, and that's okay. I was giving you shit earlier, but it's fine. I'm just gonna take it that you're not a trader. And this is the 5 minute inverse gap that I had drawn out before. So once we tap that, I thought we'd get a rejection, which is why I took profits. We did get a strong rejection and then obviously came back up. So that's the trade in a nutshell. He should be working at the Fed. Shit. I wish, man. You know how those like supercomputer hackers, in exchange for jail time, they end up working for like the CIA and the NSA. That's, you know, I don't know. If they ever send me to jail for taking too much money out of the system or something, then maybe I'll flip sides and I'll work for the Fed. I think you described this move in a recent mastermind. Yeah. This right here is part of what I taught in the last mastermind session on Sunday. Anyway, guys, appreciate you for joining. Hopefully you learned something. Glad we caught a nice trade there towards the end. Didn't have to risk a whole lot to get that either. And yeah, for those of you in the Discord, I'll see you on the Discord. For those of you that are in the meetup in New York, I will see you guys tomorrow. Can't wait to hang out with you. And those who just joined for the lols, hopefully I gave you some lols. I'll see you guys in a bit. Peace.